Every day, trillions of dollars move through the Forex market. Banks, hedge funds, and large financial institutions dominate this flow. Retail traders, people like you and me, make up only a tiny percentage of total volume, yet many beginners try to trade against these giants using small accounts, random indicators, and emotional decisions. Institutions don't trade this way. They don't chase candles. They don't revenge trade. They don't panic. They trade with structure, patience, and risk management. If you want consistency in Forex, you must stop thinking like a gambler and start thinking like an institution. What does thinking like institutions really mean? Thinking like institutions does not mean copying exact hedge fund strategies. You don't have their capital or algorithms, but you can adopt their mindset. Capital preservation first. Trading probabilities, not predictions. Using liquidity zones. Managing exposure with hedging. Scaling in and out. Staying emotionally neutral. Retail traders focus on entries. Institutions focus on risk and positioning. That's the difference. Institutions trade areas, not single prices. Retail traders look for exact entry points. Institutions work with zone. They build positions around support and resistance, supply and demand liquidity pools, previous highs and lows. They expect volatility. They allow price to fluctuate. They don't panic when price goes slightly against them because they already planned for it. Understanding liquidity. The fuel of the market. Institutions need liquidity to enter large positions. They target areas where stop losses sit. Equal highs, equal lows, trendline breaks, obvious support, resistance. This is why price often spikes before reversing. Retail traders see manipulation. Institutions see opportunity. They collect liquidity, then move price in their intended direction. Why institutions hedge funds don't go all in on one idea. They hedge. Hedging means opening positions that reduce risk while allowing profit potential. For example, long EUR/USD, short GBP/USD, long gold, short USD index. Buy one pair, sell correlated pair. This balances exposure. If one trade fails, the other cushions the loss. Retail traders usually place one trade and hope. Institutions build portfolios. Retail thinking versus institutional thinking. Let's compare. Retail trader. One trade at full risk, no hedge. Emotional decisions, move stop loss, wants quick profit. Institutional trader, multiple positions, hedged exposure, fixed risk rules, accepts drawdown, focused on long-term returns. Retail traders chase wins. Institutions manage risk. Institutions scale in and scale out. Instead of entering with full size at once, institutions enter partially, add positions as price confirms, take partial profits, leave runners. This reduces emotional pressure and improves average entry. Retail traders usually go full lot immediately. That's why they panic faster. Risk comes before profit. This is critical. Institutions define risk before reward. They ask, how much can we lose? What's our maximum drawdown? How correlated are these trades? Retail traders ask, how much can I make? That mindset alone explains most blown accounts. How retail traders can apply institutional thinking. Simple version. You don't need millions to trade smart. Here's how you apply institutional concepts on a small account. 1. Trade zones, not lines. Use support, resistance areas. 2. Aim for 1 to 2 or better R. Let winners outweigh losers. 3. Use partial entries. Don't go full size instantly. 4. Consider simple hedges. Example. Avoid stacking trades on same currency. 5. Risk. Only 1% per trade. Survival matters more than profits. 6. Think in series of trades, not single outcomes. Hedging for beginners. Simple explanation. You don't need complex systems. Simple hedge idea. If you're long Euro/USD, avoid also going long GBP/USD. Both depend on USD. Instead, diversify. This reduces exposure to one currency shock. Another example, trade one bullish setup and one bearish setup on different pairs. That's basic portfolio thinking. The institutional secret: most retail traders ignore institutions, don't care about being right. They care about managing exposure. They expect losses. They plan for drawdowns. They win through discipline and structure. Retail traders want perfect entries. Institutions want controlled risk. Final thoughts: become a risk manager first. If you want to grow in Forex, stop trying to predict every move. Start managing probabilities. Think like a hedge fund. Protect capital, accept losses, trade zones, manage exposure. Stay patient. This mindset alone can transform your trading. Conclusion: thinking like institutions doesn't mean trading like robots. It means adopting professional habits. Structured risk, hedged exposure, zone-based entries, emotional neutrality, long-term perspective. Do this consistently, and you'll already be ahead of most retail traders.